What's next for markets?
I'm Michael Kantrowitz, Chief Investment Strategist at Piper Sandler, where I lead the portfolio strategy team ranked #1 on Wall Street in the All-America Institutional Investor Research Survey.
Michael, rates continue to be the dominant story in markets this year. We've gotten some reprieve the back half of this week, but it seems to be what everyone wants to talk about. What are clients saying to you, and what are you saying to clients?
Yeah, it's interesting. It depends on the client. And I would even extend that to speaking to folks in the media. I was on a couple of networks this week, and the common response is, look, interest rates have gone up and the market's done fine. As we sit here today, markets are pretty much back to all-time highs. The Dow's at an all-time high. But what people often overlook, especially those folks that are just focused on the indices, the Mag 7, the AI story, which again is the bulk of the market, which is again why the indices are up. Underneath the market, it is not quite as rosy. In fact, I was just got off the phone with Peter Keith, who covers a lot of the consumer hardline, softline, housing related names. And he's noticed that his stocks are down because of what's going on with rates. But so a lot of conversations about the impact of rates, often people talk past each other because they're either looking at the index or they're not appreciating what's going on. And what we've been seeing, and you and I have talked about this in the last few weeks on this podcast, is the breadth of the market has been decaying since late February when this conflict started. And basically what we saw since you and I spoke last week was that on Friday, we finally broke above 450 on the 10-year. And coincidentally, that was where the market started to broadly negatively react to higher interest rates, which is interesting because that's been roughly the number that we've been referencing for the past few years, because that's also where markets have more broadly become negatively impacted rather than just some areas like housing, retail, biotech, real estate negatively reacting. So yeah, every conversation now is about interest rates. Just every conversation 2 months ago was about the Strait of Hormuz, which is still obviously part of that story. But the good news is that this week, certainly in the middle of the week and as we end Friday, rates have come back down a little bit in the US, and markets have responded very positively, particularly those areas that were under the most pressure. And that also highlights what makes it so challenging for investors is that if you don't have a booming earnings story from AI, and again, even those stocks got hit earlier in the week, some of the worst returns tend to come after interest rates have been rising for a while and break some threshold. But also some of the best returns come when rates are high and they start to come down. So yeah, that's been what the conversation has been. Why clients are asking why rates are up beyond just oil prices, which is, I think, fairly obvious. But there's also been better jobs data in the US in the last 5 or 6 months. We track the labor surprise index, and that's at a multi-year high, and that has correlated pretty well with the 10-year yield since 2023. Much of the other cyclical macro data, too, has been fairly strong this year, like the ISM Manufacturing Index, the Empire Fed Index. And so there's really, when people talk about why rates are up, the answer is it's all of it.
It's a good point you make about breadth in the overall index. Anytime a macro event happens and that is the focus of investors' attention, you start seeing a lot of work from people. What are some of the things and questions you've gotten related to interest rates in the market?
Well, yeah, that's been a debate for really going back to 2023, certainly when after the Fed started aggressively tightening, whether or not the US economy was rate sensitive, whether or not the stock market was rate sensitive. And again, people would point to, look, the Fed hiked aggressively and the economy didn't go into recession. And the Fed hiked aggressively. And after inflation finally rolled over, the market went straight up in 23 and 24. And so again, that goes back to the point I was saying about the market. It's the same about the economy. Yeah, the overall economy was fine in the aggregate, but if you broke it down to services versus manufacturing or tech versus consumer, or even within the consumer, high-end versus low-end consumer, this is why everyone's talking about a K-shaped economy. So clearly, rates did do some damage to parts of the economy and parts of the stock market. And so I feel like that pushback on rate sensitivity is quieted down because it's, I think, become fairly consensus that rates do matter. It's just they matter in some places more than others. But also, I've gotten most recently, I posted a chart on X talking about this, how interest rates are rising, and it could be a problem for equities. And listeners can see it for themselves who published it, but I don't have to name the bank. But someone did a study, and basically they looked, I don't know, over 80 years and looked at median market returns across different interest rate levels. And what it showed was there's no relationship, that over the 80-year period, stocks have done fine in higher and lower rate environments. And the conclusion was rates don't really matter and everyone's just making a story where there's not one. I think the analysis there, and certainly I think the conclusion was wrong, and I think the analysis was short-sighted and incomplete. What is being overlooked if you look at 80 years of history is that during some of those 80 years, like the 60s and 70s, rates were rising. And so at different levels, we clearly saw the markets go down in the 70s every time interest rates moved higher. And then in the 80s and 90s, interest rates came back down through those same levels, but because they were falling, markets loved it. So if you average out markets hating higher rates moving higher and markets loving rates moving lower, you're going to get a conclusion that it doesn't matter, but that's because your analysis is, how can I say this kindly, incomplete. And so what I retweeted the chart, added some insight to it that one, that type of study did not acknowledge that one, correlations between interest rates and equities have changed, have had regimes that have been drastically different. And again, rates moving higher in the 70s crushed the equity markets, and rates moving lower in the 80s propelled the equity markets all the way even through the 90s and into the early 2000s. So you go through different regime shifts in terms of correlations. And of course, we all have now seen, and again, we're seeing it right now, since 2022, anytime interest rates have moved up for a while, they start to negatively impact the market. So that study also didn't recognize that, again, within a different level of interest rates, it matters if rates are higher or lower. So right now, the 10-year has been above 450 for a week. And if you look at the average return, you'd be like, the market's up. Yeah, but look at what the market did on Friday, down broadly, and again, Monday, and then Tuesday, Wednesday, Thursday, or I'm not sure if I'm getting the exact days right, but as rates have come down the last couple of days, the markets have broadly rallied, and the best performers have been retail and housing and consumer related names. It does matter not only the level of what you're at, but it matters the direction you're moving at that level. And we are at that point today where equity market returns are going to be amplified because we're at a higher level. And that means you're going to have more broad pain when rates rise and more broad relief when rates fall, which is exactly what we have seen the last 5 trading days.
And this isn't the first time in this cycle that we've seen this. We've seen this kind of higher rates, range bound reflexivity in markets.
Yeah, that's the thing too. And there's nothing that's been more debated over the last 3-4 years than where interest rates are headed. And there's tons of interest rate hawks or bears talking about focusing on the deficit, focusing on inflationary price pressures and a dollar debacle leading to much higher rates. The 10-year's going to 6, 7. And then there's folks that are just really bearish on the economy and talk about rates going back to 0. And the reality is no one's really been right. I've counted now 9 rotations in the narrative of where rates are headed since 2023. And now this is the 10th time where, and we've seen this, you're right, about four or 5 times over there since 2023. And the same thing happens behaviorally every single time. Rates go up for one reason or another. And obviously, again, today it's largely oil prices, but it's also better economic data and particularly labor. And then people start worrying about the housing market again. You could find articles about that today. They start worrying about the deficit again. You find articles about that today, and they start pricing in the Fed raising rates and the worry that brings. So you can obviously see that. And I think we're now pricing in more than a rate hike today. And again, this obsession with where's the Fed funds rate for December? What's the Fed going to do? The problem is over the last 3 years, whatever you thought, whatever the market had priced the Fed to do at any given point, 6 months later, rarely was that actually the same view. So the odds just based on that in December, the Fed does actually hike, I don't think are as high as the market currently expects, because as you and I both, I think, see the world and the markets, a view in December is largely influenced by everyone's view today and an extrapolation of that.
Absolutely. So it sounds like you think we're once again at the higher end of the range and they're going to continue to see over the short term rates come in some.
Yeah, and for a few reasons. And obviously, oil in the Middle East is a wild card, so it's hard to handicap that. That said, if you think about last year with tariffs and what probably pushed President Trump to pause, and what's happening now in financial markets with interest rates, I think the bond market continues to be the world's best negotiator. And we're seeing interest rates go up in Japan, in the UK, in the US, around the world, basically. And nobody likes that. So I imagine there's going to be, and there has been increased pressure, both externally and internally within policymakers and in DC. And any further increase in rates, I think, will accelerate and increase the probability that things that are going on in the Middle East are going to end sooner than later. And perhaps that's one of the reasons why we haven't seen more of a swift end to what's going on in the Middle East. Obviously, it's very complicated, and perhaps that's oversimplifying it, but we've certainly seen many times in the past where bond yields solve the problem one way or another.
So what else are you keeping an eye on for what could push rates lower?
Besides oil prices coming down, which would certainly be the best way to get rates down, there's a couple of patterns that we've seen evolve over the last several years where there's been a very clear reflexive behavior within the economic data and ultimately the stock market and within bond yields. So simply, in the last several years, when we have seen rates also go up for 2, 3, 4 months, it didn't last much longer than that because you started seeing the economic data weaken. You started seeing the stock market more broadly negatively react to it. I think that just exhibits the reflexivity we have in this economy. In a K-shaped economy, particularly with the unique nature of today's housing market, it's hard to push rates very low and keep them down there because, as we've seen in the last few years, every time rates do come down, we see housing activity positively respond. And that's increased because mortgage spreads have come in over the last couple of years, about 150 basis points. So, and that's one of the positives too, is that mortgage rates are not nearly as high as they were the last several times. The 10-year was at, let's say, 4.5 or 460. So I think it's really hard to see a growth slowdown in the economy because if rates come down, I think that will provide, with a lag, a lot of relief, which will push rates back up, which again, I think we've seen that. We certainly observed that the last few years within a lot of the cyclical data. On the flip side, when rates go up, as we've seen now the last several months, particularly when it's joined with higher oil prices, that's going to have a softening effect and a dampening effect. Again, it's starting to more broadly impact the market. It's certainly impacting the consumer data. We saw on Friday, UMISH hit another all-time low, as did real income expectations. So you are crushing the parts of the consumer for sure. And any slowdown in macro data is actually typically bond bullish. And again, that's what we've seen several times in 2024 and also in 2025. That ultimately led to some small upticks in unemployment. I would even say right now, getting a small uptick in unemployment could be actually a bullish thing, certainly for bonds, but also for equities. The real bullish case, if one wants to dream from here, is that sooner than later, the war does end. Oil prices do drop to a lower level. They're not going to go back to $50 anytime soon, but the market would take any drop in oil prices. Rates come down with that, so you get a real big, broad pickup in the market. And then you see the lagged after effects of higher oil and rates for the last 3 months, and you get some softening in the data, which pushes rates even lower. I think investors would probably look through some of that, any demand weakness coming from the rate increase that preceded it, but would certainly welcome any drop in rates and perhaps an unwinding of the current Fed expectations for tightening later this year.
So a little bit of softer data would be Goldilocks for markets.
Yeah, absolutely. That was the case in 24 and 25. And that goes back to this environment we are stuck in where everyone's worried about inflation and interest rates moving higher. And one of the clear ways to remove those fears or limit those fears is to see some softer data, particularly in employment. And that's one of our big conclusions of the last several years, this regime shift. It really means investors need to worry about and respect interest rates a lot more and not worry so much about growth slowdowns, because that would more likely bring about lower rates, which in this regime, until we stop talking about affordability, until you stop reading about it, watching and hearing about it on the financial networks, that's not going to be this year. It's not going to be next year. Until we move past that, anything that really drives rates lower, I think is going to be bullish for equities.
Thank you, Michael. I know rates is a topic a lot of investors are interested in right now, and there always seems to be some sort of macro force at play that's got to keep stock pickers on their toes.
Indeed. And I think it's an interesting time now, and I think there's some opportunities because I would say most investors are very bearish on the consumer. Most investors are rightfully bullish on much of the AI story. And most investors, I would say, are bearish on interest rates or bearish on bonds. I expect rates to stay at these levels or even go higher. So there are many stocks that have gotten just beaten down for the last 3 months. A lot of them are in the consumer sector that have gotten a lot cheaper. And they've gotten cheaper rightfully because interest rates have gone up. And if those interest rates, for whatever reason, come down over the next few months, which we think there's a pretty good probability of that, we could actually see consumer stocks actually being the bright spot of the market.
Thanks again, Michael. See you next week.
All right, Stephen, have a great long holiday weekend.
We hope you enjoyed today's episode of What's Next for Markets. You can subscribe to the show on Apple, Spotify, YouTube, or wherever you get your podcasts. Be sure to follow Michael on X at Michael Cantro. If you like the show, please let us know by leaving a positive review. The preceding commentary is not financial advice. You should always seek appropriate financial advice from a professional financial advisor in your state. You should not consider this as a substitute for these services. Piper Sandler does and seeks to do business with companies covered in its research commentary or coverage. As a result, investors should be aware that the firm may have a conflict of interest that could affect the objectivity of this commentary. Investors should consider this commentary as only a single factor in making their investment decisions. For full disclosure information, visit www.pipersandler.com/researchdisclosures.